Welcome to the Stake Beginner's Guide to Investing. So although Stake is a property investing platform, we like to give our customers and the people who use the platform just broader investment advice. I think it's really important that for us anyway, that our clients and our customers are well informed about not just property investing, but what is have a bigger, broader picture on investments. And so we're going to use this video to give you if you're a beginner in this field and you want to take the first steps towards investing your money wisely, some really sound, sage advice. And I can't think of anyone better to do that than our co-founder, Manar. Manar, welcome. So Manar, you've spent your career in finance for the last 15 years, giving the most advanced investors advice about how to get great returns from their money. And what we want to do is just take those pearls of wisdom and impart them on our customers. So taking off your stake hat and just being someone who gives good, sound advice. I'm starting out, I'm day one, I don't know a lot about investments. Where do I start? How do I get the ball rolling?
I think first of all, the first starting point for you as a beginner in investing is to start thinking about it the right way. It's about framing your mindset to think like a owner of a business when it comes to stocks, which are effectively businesses. Owning a stake in those, or owning a property or an underlying asset, right? Typically, the average person would immediately think about investing as something that is quite short-sighted, and how much can I make and immediately when it comes to investing their savings or their money, because they want to hit it out of the park. Usually, that's kind of the thinking around the average person's mindset.
Easiest way to lose money usually is.
But it's right? Exactly, and investing sometimes is actually quite a boring activity when you think about it, because it's all about looking at it from the perspective of how much am I going to make over a longer term period. If you think like a get rich quick type of mentality, you're running a dangerous kind of game, because the short term price direction of any asset can be subject to very wild swings that have nothing to do with the long-term value of the underlying business or asset that you're buying.
Right.
So it's extremely important to frame the mindset of what you're actually doing before setting out to do it, and not thinking like a gambler mentality.
Yeah.
And so the starting point is to say, hey, I want to find the best, or I want to put together the best plan to be able to grow my wealth over time in the safest and most consistent and sustainable way as possible. Yeah. So that's the starting point. The second bit of, I think the second element that you have to have as a beginner is to say, hey, timing the market is tough. So just to take a step back, anything that you invest in is an asset that has a price that will fluctuate and that has a market, buyers and sellers. And so the price of that asset goes up and down over time. It's variable, and no one can predict the future when it comes to tomorrow, a week from now, a month from now, even a year from now.
Yeah.
But it's about positioning your investments to be beneficiaries over the long term. And so trying to perfect the timing of your entry point is a common mistake that people think is too late, too soon, the best institutional investors that have hundreds of millions of dollars to spend trying to time the market do that, and a lot of them actually don't get it right. So for the average person to think that he can do it right himself is a common misconception. And so the best way to grow your wealth is by investing steadily over time and actually maximizing the power of compound returns and diversification. which are the two, elements of investing that people don't think about commonly, but they are the most powerful tools for investors ultimately to make consistent returns without losing money.
Yeah.
And having a portfolio that's well diversified is actually the best thing that investors can do.
So I was going to ask you about your kind of guiding principles and the mental models you use, but that's pretty much it.
It is. Yeah. Those two principles are the most important ones.
Yeah.
If you diversify well your capital, your investment portfolio, you can make the same return in a safer way. So they say you lower your risk without lowering your expected return.
Mm-hmm.
So that's the basic, I think what they call the cardinal rule of investing is to not concentrate your capital in any one asset that may be subject to specific events that relate to that asset that you didn't calculate. The unknowns will pop up always, and you should fear being wrong always in investing. Mm-hmm. So one of the key ideas that investors need to come to terms with is that no one knows the future, and everybody should be asking themselves quite healthily is having a fear of being wrong. So what do you do to mitigate for that is you spread your bets, essentially. Although it's not the same bet as gambling, it's important to differentiate from that gambling mentality. The bet that you're making is, am I placing my money in the right place to grow over time?
Yeah.
That's the bet that you're making. And the second cardinal rule is when you're starting off as a beginner, go in gradually, and if you invest consistently, you can compound your returns over time. What do I mean by compounding? Mm-hmm. That means every year's return, if it gets reinvested, continues to grow even more if you have a longer term horizon, and ultimately you'll end up with more, and markets over time end up growing in value. You just have to stick and stay the course.
I don't know if I'm misquoting here, but I think Albert Einstein once said the most powerful force in the universe is compound interest.
Yeah.
So it could be one of those quotes that's often misattributed to him, but point taken. So there's a lot of good advice out there, but there's a lot of really bad advice out in this. The field of investing is probably as filled with charlatans as my own field, which is marketing. But there's some really good advice out there too. So are there one or two individuals you could maybe point people to that after they watch this, go and read everything they've written? One or two names that they should say, this is sound, sage, good advice. They're not a charlatan.
There's plenty of resources in today's world. We're very ultra connected with social media, and resources that are available at our fingertips in the digital world that we live in. But I would advise for the beginner investor to read a great book by Tony Robbins called Unshakable, which is a condensed version of his original book, which was a bestseller called Money Master the Game. There he interviewed the biggest, most successful, legendary investors like Warren Buffett, Ray Dalio, Jack Bogle, David Swenson, John Paulson. Fantastic, kind of advice in that book to give you the right framing and perspective that I was talking about earlier, and the tools to get there. Because sometimes what you think in terms of investing is like I was mentioning, is not the right way to be thinking about it. So that I would highlight that as a very useful resource. And if you follow legendary investors like Warren Buffett, Charlie Munger, you cannot go wrong. Ray Dalio, I personally love his book Principles. Was a fantastic. It had a big impact on me. So I can't recommend it highly enough.
Okay, so that great advice. I guess learn from the best.
Correct.
There's so many places you can put your money when you're starting out, and more importantly, there's a lot of places that you probably shouldn't put your money if you're not an expert. So I think the question is, if I'm a newbie, where can I start testing the water? Like you said something really interesting, which was start gradually. Where can I start gradually where I'm not going to get my hands burnt? And is there a whole set of trading platforms or asset classes that really, until I'm more of an expert, just avoid, because they're complex, difficult to understand, you need a bit of experience. So where should you maybe move towards versus just shy away from, because you're playing in the Premier League, you need to start out in a local league?
Yeah, I see. Okay, I see the question, and for me, it's important to invest in the first place, right? To not put your money idle, sitting in an account. And so you have to get started somewhere. Now, I won't touch on necessarily what are the best, most, I would say, what are the platforms that you should use, whether it's a online digital platform or a private bank. You have to look at fees, and for me, I find going down the low cost route is always better, and it's a lesson that comes out in the readings that I've learned. Is mutual funds and private banks and so on. You have to analyze how much you're making net of their fees, and those fees add up a lot when it's like 1, 2, 3, 4% per transaction per recurring period. They add up. So that's you have to be smart.
Are so rich.
Yeah, exactly. But taking a step back, the advice I would give is to build a diversified portfolio of both liquid financial assets and alternative, more illiquid assets, which real estate typically falls in that bucket. Okay. And there's no rule of thumb as to what is the perfect blend. I would advise to do 50-50 or 60-40, because again, the liquid portfolio you can liquidate immediately in case of an emergency.
Right.
But going further into that thought is that you shouldn't really kind of rely on liquidating because you're a long-term investor. So you park that asset and you park that money into those assets and you sleep on them. And the way you diversify, even in that financial, within that liquid pool, is not by stock picking, okay? Because again, you're not going to get it right. Yeah. It takes a lot of professional expertise to stock pick and find the best value within an individual company when you're picking stocks. Yeah. You are much better off buying the market, an index tracker, an ETF that is very low cost. There are plenty out there. Vanguard is the gold standard usually. In those trackers that you can access through either, again, online digital platforms or through any other medium that you have to access the market. When it comes to alternative assets like real estate, you have the traditional way, which is to buy a property, which we believe is inefficient when you want to allocate a certain amount. Yeah. And especially it's impossible to be done with an amount of 10, 20, 30, 50,000 dirhams. You'd have to get a lot of leverage, or you have to borrow money in the form of a mortgage to buy a property with that little amount up front, if any. So to cut a long story short, allocating to real estate in the most efficient way for the construction of your portfolio, an account with stake would allow you to do that, also with the mind frame that you're a long-term investor and that this is a 5-year kind of investment horizon that you're signing up to be able to get the best possible returns, not just from your passive income of renting the property, but also growing its value over time through capital appreciation.
And is there anything specific that you would, apart from stock picking, that you would stay well clear of, like day trading, crypto, future, all that stuff?
Look, stock picking and day trading is sort of similar. You don't, day traders usually go after individual stocks and try to bet on their short-term price fluctuation. It takes a lot of time and effort.
Yeah.
And again, like I say, if you're not an expert, you shouldn't go through because the average retail person gets kind of emotional also by seeing losses.
Ups and downs. Yeah.
And this is another really important rule in investing, is that you have to try and be able to separate your emotions from your objective thinking, higher level thinking. And be able to stomach any paper losses because you have such a strong conviction over the longer term. So, but people think otherwise and panic.
Yep.
And that's why on the way down, markets tend to, it tends to exacerbate the way down in terms of price movement because there's so much selling action on the way down that people want to sell because they're scared about losing more. Yeah. And so the fear settles in. And in investing, you have to be able to separate your emotions from your objective thinking.
Okay. Well, one final question when it comes to planning, say, your retirement, or when over time. So you're someone in your 30s and 40s versus someone who's nearing retirement. Do you change the types of assets you invest in, or the mix of your portfolio the closer you get to retirement? Because I often hear you should be moving from higher risk to lower risk the older you get.
Absolutely.
So how does that work, and how do you do that?
Because your objectives change, and so in investing you have to firstly understand risk, return, and have a certain objective in mind, and evaluate your own tolerance for risk, because you can get more return by taking on more risk, but are you willing to bear the consequences over shorter term periods, and when you're at an older age, you don't want to see, you want to leave behind as much as possible for your family.
If you get burned, you don't have another 10 years to make it back.
Exactly.
Right.
Correct. So you have less benefit of time, so you should take less risk in your later part of the years. Try to safeguard and preserve your wealth as much as possible.
Yeah, we often at Stake talk about where we sit in that asset class spectrum, right? So you've got money in the bank, then you've got bonds, gold, stocks, shares, the kind of crazy stuff, the crypto stuff. Where do you see Stake sitting, and what role does it play in a nice diversified portfolio?
It's a good question. So property is a unique asset class compared to others. I like to compare it as a hybrid, or a combination of the features of a fixed deposit, or even you can look at it as a bond to the bank. Essentially, you're giving your money to the bank, and they're giving you a deposit rate, and your capital, they owe you that money when the deposit expires. So you're not making any growth, but you're making a return of a very fixed percentage that is a lot lower risk, a lot more predictable. And again, banks in our part of the world, here in Dubai, for instance, are very safe and sound, that you can, it's as good as almost cash. Yeah. Right? When you invest in stocks, you're buying the discounted value or the discounted cash flows of a business, betting that it's going to be growing its revenues and income, and ultimately that drives the value of the business to grow.
Yeah, so you're buying the future expected value of that business, not what it's worth today.
Exactly.
Right.
You're essentially taking a view that expected value is more than what it's trading at today, or it will grow over time. So that capital that you allocate to it is going to give you a lot less predictable cash flows than the bank, because dividends can fluctuate more depending on how profitable that business is over any given year. But what is important to highlight is that you're looking at growing the value of your shares in that business over time. Real estate is somewhat like in the middle, because you have that predictable cash flow from rental yield, right? And if most real estate markets are stable markets, and in certain places like Dubai, at the moment, you can say there's very little downside in buying properties at the current levels where we are today, which are very close to, if not less than, replacement cost. So you can then kind of look at it as a safe storehold of wealth that is also hedged from currency depreciation, dollar depreciation, and so on, or inflation. And so it's a real tangible asset. It's unique in that way, different than either one of the two asset classes I just mentioned, whether it's bonds and fixed deposits with banks, or stocks that are financial in nature. Here you are talking about tangible, real, hard assets that have a productive use. Like people can actually live in them.
People need a place to live.
So it gives a lot more stability and security to your portfolio in general to have an asset class like that. And it gives you the best of both worlds, because the part that I wanted to allude to is that real estate can grow in value just like a stock would, right? So you're getting a mixture of both. And interestingly, there's a academic paper that was produced, I think it was University of San Francisco. Academics looked at the return on everything, pretty much stocks, bonds, and real estate, in multiple countries, I think if not mistaken, about 16, 17 countries, and going back to 1870. And real estate performed the best as an asset class compared to those, to stocks, to bonds for sure. And in terms of volatility, which is a measure of the risk, it had the best risk-adjusted returns. So by going into putting part of your money in real estate, you're not sacrificing too much by way of return at all, if any at all. Actually, you're enhancing some of it, especially from a risk-adjusted basis. So that's why we say diversifying your portfolio into real estate lowers the overall risk of your portfolio without lowering the expected return.
You said something earlier that I found interesting that I now maybe to end this on, which was you said when you when you invest in anything, think of it like you're investing in a business. Buy into something you really know. That's why I think property is interesting, because everyone knows what a house is.
Correct.
Right? But when you buy into a stock or share, you don't know what that company does most of the time, and you're not really buying into one individual. You don't. If you're buying into a market, you might not be an expert in the market. When you buy a house, it's just as an asset class, so intuitively easy to get. It's a house, people live in it, they give you rent, property prices go up, go down, you buy and sell. And so if you're if you're an early stage investor, it's something that you can intuitively grasp with relative ease. It's an easy price.
Absolutely.
And that's why we think Stake is one of those platforms that we think is going to be great for both it delivers great returns for the seasoned property investor, but for those entry level, it's easy to get. You're not going to get your hands.
It's a great starting point, exactly.
Right.
Especially in today's market.
Thank you very much.
Thanks, Chris.